When it comes to making money on the stock market, dividend stocks are an option that many investors find to be appealing. These kinds of stocks offer a consistent flow of income in the form of dividends, which are payments that are made by a company to its shareholders on a regular basis. The Dividend Kings are a subset of dividend stocks that have received a significant amount of attention over the past few years. Let's have a deep look into which Dividend Kings to buy. What are Dividend Kings? Companies that have a long track record of not only paying dividends, but also increasing those dividends over time are considered to be Dividend Kings. For a company to be considered a Dividend King, it must first meet the requirements of having increased its dividend payout for at least 50 years in a row. Because of this, they are a dependable choice for income-seeking investors who place a high value on stability and consistent return rates. Let's delve deep into the topic of dividend stocks that investors should buy and hold forever. If an investor is looking for a reliable source of passive income, investing in Dividend Kings may be a good strategy to consider. Dividend Kings provide consistent dividend payments which can help to hedge against the volatility of the market. In addition, Dividend Kings typically have a strong financial position and a long history of consistent earnings growth. This can give investors a sense of stability and confidence in their investment by providing evidence that the investment is a sound one. Here are some of the top Dividend Kings to buy. Number 8. Emerson Electric. Over the course of its more than 125 years in business, Emerson Electric has evolved into a diversified technology company. It has a robust product portfolio that includes Copeland compressors, InSinkErator food waste disposers, and Rigid tools, among other notable brands. Because this firm has maintained a pattern of annual dividend hikes for the past 64 years in a row, it is currently considered one of the best Dividend Kings to invest in. Its payout ratio currently stands at 55.41%, while its dividend yield is currently at 2.08%. Number 7. Genuine Parts Company. Genuine Parts Company is a wholesaler that distributes automotive replacement parts, as well as industrial parts and office supplies. It has been in operation for more than 90 years. It also maintains a significant footprint across North America. Because the firm has maintained a pattern of annual dividend hikes for the past 65 years in a row, it is currently considered one of the best Dividend Kings to invest in. Its payout ratio currently stands at 56.03%, while its dividend yield stands at 2.91%. Number 6. Colgate Palmolive. Over the course of more than 200 years, the consumer goods company known as Colgate Palmolive has been in operation. It has an extensive portfolio of brands, some of the most well-known of which are Colgate toothpaste, Palmolive soap, and Speed Stick deodorant. Because the firm has maintained a pattern of annual dividend hikes for the past 58 years in a row, it is currently considered one of the best Dividend Kings to invest in. Its payout ratio currently stands at 59.20%, and its dividend yield is currently 2.27%. Number 5. Canadian Utilities. Canadian Utilities is a $8.07 billion business with about 5,000 staff members. Canadian Utilities has 53% ATCO ownership. Canadian Utilities, a global energy infrastructure company with a base in Alberta, offers services in electricity, pipelines and liquids, and retail energy. The company boasts Canada's longest dividend increase streak of 50 years. Canadian Utilities reported Q4 2022 and FY 2022 results on March 2, 2023. Revenues rose 15.2% to nearly $3 billion, and earnings per share rose to $1.53 from 96 cents in fiscal 2021. Customer rate relief in 2021 due to the COVID-19 pandemic and the decision to maximize 2021 deferred revenue collection in 2022 caused these increases. Higher electricity and natural gas commodity prices at ATCO Energy, higher flow-through revenues in natural gas distribution, rate-based growth in Alberta utilities, and revenue from the Alberta Hub natural gas storage facility acquired in December 2021 all contributed to higher revenues. Number 4. Leggett Platt. Leggett Platt is a manufacturer that specializes in engineered products. The company manufactures a variety of goods, some of which are die castings, furniture, components for bedding and bedding sets, store fixtures, and industrial products. Leggett Platt is comprised of more than 20,000 employees and 14 distinct business divisions. Over the past century and a half, it has maintained a pattern of annual dividend increases. The projection of the management team regarding the expected level of revenue for the current fiscal year has been brought up to date. The fact that the company forecasts revenues to fall somewhere in the range of $4.8 billion to $5.2 billion suggests that revenues will probably either remain the same or decrease during this year. The guidance for earnings per share for the year 2023 has been set at a range between $1.50 and $1.90, and this range was decided upon. Number 3. 3M Company. More than 60,000 of 3M's products are put to use every day in homes, medical facilities, commercial establishments, and educational institutions all over the world. It has a workforce of approximately 95,000 people and provides services to clients in over 200 countries. The company has been increasing its dividend payments for 63 years in a row, bringing the total number of years it has been increasing them to over 100. The increase in the dividend that 3M was required to pay out in 2022 was 6%. The company stating that it will split its healthcare division off into its own entity made a separate announcement. Given that the healthcare sector as a whole generates annual revenue of more than $8 billion, this announcement is of the utmost importance. Before the calendar year 2023 comes to a close, it is anticipated that the transaction will be completed in its entirety. Number 2. Universal Corporation. Universal Corporation is a tobacco stock which exports and imports the most leaf tobacco. The business is a middleman between tobacco farms and the businesses that make cigarettes, pipe tobacco, and cigars. It is a wholesale purchaser and processor of tobacco. Universal also sells ingredients. November saw Universal Corporation's fiscal 2023 second quarter earnings. Universal Corporation's quarterly revenues rose 34% to $1.1 billion. Management says a better product mix drove revenue growth. Operating income increased year over year despite Universal's gross margin failing slightly. Due to higher operating income, Universal's adjusted EPS was $1.13 in the quarter, up year over year. However, earnings per share may rise in the coming years. Universal's earnings and cash flows justify its moderate valuation. Universal can use a lot of its free cash flows for share repurchases and dividends because it does not need to invest much. Universal's dividend payout of round about 79% for the current fiscal year is moderately safe, but the tobacco industry's steady decline poses headwinds. Number 1. Altria Group Inc. Philip Morris established Altria Group in 1847. It is a major consumer goods company today. In the U.S., it offers Marlboro cigarettes along with several other non-smoking brands like Skoal, Copenhagen, and others. In addition to holding significant stakes in Juul, a manufacturer and distributor of vaping products, and Kronos Group, a cannabis company, Altria also owns 10% of the world's largest beer company, Anheuser-Busch InBev. In the U.S., the retail market share of the Marlboro brand is over 42%. Altria released its third quarter financial report on February 1, 2023. While its revenue of $5.08 billion missed the analyst estimates by $70 million, its quarter 4 non-GAAP EPS of $1.18 beat analyst estimates by 2 cents. The management's plans for 2023 include continuing their approach to strike a balance between strategic investments and shareholder returns and earnings growth. The company projects that its full-year adjusted diluted EPS for 2023 will be in the $4.98 to $5.13 range, up 3% to 6% from the base of $4.84 in 2022. It anticipates that its adjusted effective tax rate for the entire year will be between 24.5% and 25.5%, and that capital expenditures will range between $175 million and $225 million. The company approved a new $1 billion share repurchase program, and it will be finished by December 31, 2023. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.